In this short recording, we're going to finish off the last remaining areas in the topic of accounting measurement. So in week 2, we looked at historical cost accounting and we looked at current purchase power accounting. And then this week, week 3, we finished off looking at current cost accounting. And in each one, we said you need to understand the concept, you need to understand the mechanics or how to do the calculations, and also then the pros and cons of each one. So the last one is kind of a variation or a form of current cost accounting known as the exit price accounting, where you value assets at their net selling price. So this is distinct from current cost accounting, where you're valuing assets at the replacement cost. That's how much it costs to replace the asset. This is what you would actually get to sell that particular asset that you own. And his whole logic here is that this gives you more effective information for decision making. That you want to know what can I sell the assets for in their current state. So it focuses on the capacity to adapt. Profit directly relates to those changes in adaptive capital, which is the exit values of assets. But of course, the big issue here is, can we actually measure the value of each of those assets regularly and accurately? So it's kind of a different perspective. It's not focused on what you can replace the asset for, it's what you can sell the current asset for. Slightly different focus. So financial position in exit price accounting, which is another normative accounting theory, is focused on determining the market values. So the movements in the financial position of a company will move as the conditions of the environment change, or as the market value of those assets change. And the big pro of exit price accounting is the additivity problem of historical cost accounting is now removed, because it makes logical sense that you can now add up all the asset values because they're all valued at their current fair value, their current market price that you can sell them for. So there's no this problem of adding assets that cost a certain amount of money in 1980, adding that with an asset that cost a certain amount of money in 1990, and they're all at different time periods. That's the additivity problem we talked about in historical cost accounting. Right? The criticism, of course, it never gained widespread acceptance because there was a shift in the concept of profit then. You needed detailed knowledge of the cash equivalent of each of the assets. What was the exit price of each of the company's assets? So it took a lot of time trying to figure out what's the exit price for property, plant, and equipment, the exit price for receivables, for inventory, and it was quite subjective in a lot of the estimates that are required. And of course, another big thing that you would have covered in AF1 is this really sounds like we're preparing the company's accounts on a breakup basis. That if you've any concern about the company's ability to maintain itself as a going concern, i.e., to continue operating, well, then you wouldn't value the assets like you would in historical cost accounting. You'd value them all at their breakup price. So whether or not the exit price accounting was inconsistent with the going concern assumption caused a lot of trouble, and that's why it really didn't gain widespread acceptance when it was proposed back 2 or 3 decades ago. So I said you don't need to know calculations for exit price accounting, just to know that it does exist and that it's a kind of a form of current cost accounting, that you don't look at the replacement cost of the assets now, you look at the exit price, i.e. what you could sell those assets for in a fair market in the current time period. So they're the four main ones we looked at in terms of the financial statement measurement methods. And all of these in themselves, they are normative or prescriptive accounting theories, which means they're a prescriptive way of telling you this is how accounting should be done. The main one that's currently in operation is historical cost accounting. All of these have been proposed over the various decades, but none of them really have gained widespread acceptance. And we'll look at that in the next couple of slides, what the level of support has been for each one, and why historical cost accounting still continues to be the dominant framework that's been used in business today. So in terms of support for the various approaches, like towards the 60s and 70s, when there was periods of high inflation, there was a lot of support by the standard setters, so the International Accounting Standard Setters and the Financial Accounting Standards Board in the US for current purchase power accounting. And because they realized that historical cost accounting was giving to misleading financial figures and leading to overstatement of profits. However, then it shifted towards current cost accounting as they felt that maybe the generic price indices adjustments of CPPA were too, I suppose, subjective and they weren't really giving realistic and useful information. But once that started to happen, like standard setters did issue some recommendations in favor of these, the support started to wane as inflation started becoming under control. And in the 90s and into the 2000s, as we've had more stable inflation figures, which has been the focus, of course, of the central banks, there really hasn't been that focus on the big limitation of historical cost accounting, because it realized that HCA was probably the best of them despite its limitations. Right? And there's limited evidence the stock markets reacted to either CCA or CPPA. So when you brought in this adjusted accounting information, it wasn't that they felt there was extra information given over and above historical cost accounting. And we can see from studies of historical cost accounting, markets do still find it useful. So the share price does react as accounting information becomes available. So it's not that it's completely useless, right? So as well as looking at the market reaction to these in terms of how the market reacts when these accounting information is released, they also surveyed managers. And in general, they find that there's limited support. There's again the cost involved of trying to figure out what the replacement cost of each asset is, and the lack of agreement as to the approaches. It generally indicates that information is not useful. So although some people find it useful to give a voluntary disclosure, in the last 20 to 30 years, there hasn't really been a big cry for an alternative to historical cost accounting. Because of the limitations of each of the approaches, historical cost accounting still seems to be the best of the bunch. All right. So again, because of falling inflation or at least stable inflation, there's a question of whether we need this type of information or changes. It is a drastic change to the accounting conventions. What we mean by that is we change how we measure profit. Like under historical cost accounting, we know profit is selling price versus historical cost. Whereas when you go to current purchase power accounting, you now have to adjust for monetary gain or losses. Or when you go to current cost accounting, you now have issues around holding gains, realized gains, and unrealized. So it really complicates things, and the cost involved in that probably outweighs the benefit. And of course, there'll be a new method of accounting for taxation in terms of how do you determine taxable profits and what impact that would have on the tax standards as well. So there are a number of different reasons why there was a lack of support in general for all alternatives to historical cost accounting. There is now a rise of what we know as fair value accounting, which has become increasingly popular in accounting rules. And it even has its own standard, IFRS 13, that tells you how to calculate to determine fair value accounting for line items in the financial statements. This is not dissimilar to exit price accounting, albeit fair value accounting is really just a tweak to the historical cost accounting framework, in that you will measure certain assets at fair value, particularly financial instruments like share investments, like loan investments. And that was very relevant around the 2008 financial crisis, where a lot of banks had loans that were held at their historical cost, but they were actually overvalued because their true value, their fair value, was much lower because a lot of those loans were in arrears and impaired. So the big issue now is how are the accounting standards bringing in this concept of measuring particular assets and liabilities at fair value. So they're not changing the overall historical cost accounting framework, but they're picking and mixing certain assets to measure at fair value, whether that's property, plant, and equipment, whether that's intangible assets, which we'll cover this year in IAS 38, or whether that's financial assets or financial liabilities such as loans and bond investments. And we can see I just took a couple of headlines. Do not blame accounting rules for the financial crisis. Fair value accounting, are you ready? Or is fair value to blame? Is it fair to blame fair value accounting for the financial crisis? So you can Google that for a number of different articles. And one of the questions in your question pack for this topic will look at the concept of fair value accounting and whether or not it had a role to play in the financial crisis. Because remember, if you start measuring things at fair value, you're bringing in more subjectivity. When it was measured at historical cost, it may be outdated, but at least there was an objectivity there to say, well, go back and look at the transaction, we can see what the historical cost was on that date. Whereas when you bring and measure at fair value at the end of each period, then you have to get someone to estimate the fair value, which can involve subjectivity. And as the market prices go up or down, your fair value will go up or down, which means you will have much more volatile financial statements, profits going up or down as your fair values move. And so there are limitations in terms of fair value accounting as well. So it's just important to have an appreciation that this is a moving or an increasingly frequent movement we're seeing in new accounting standards, and it's becoming part and parcel of financial statements. And keep an eye out in your question pack for a question around that, and see the narrative in terms of suggested solution. So your summary here is historical cost accounting is still the current basis. It has limitations, the additivity problem, overstating profits in times of inflation, but the alternatives, they aren't perfect either. And these are all normative theories of accounting. Each of them, current purchase power accounting, current cost accounting, and exit price accounting, they all have benefits, but they all have limitations as well. And in general, over the last 2 or 3 decades, their their disadvantages have outweighed their advantages. And that's really why they haven't taken off, and why historical cost accounting has maintained its position as the mainstay framework in terms of how financial statements are prepared. And the one to keep an eye out, you might have a look at recent news articles, and I give you a couple of headlines there. Just have a look at fair value accounting and the increasing debates around that as a framework and accounting measurement as well. Right. So have a look at the Deegan and Unerman chapter 5. Again, the GCU library is offering a scan and send service, and the Elliott and Elliott textbook should be available as an ebook on the DCU library's website as well. There's a full question pack, both numerical and narrative questions to practice on, and there will be a tutorial in week 4 which focuses on accounting measurement, a mix of narrative questions and also a computational one to consolidate your knowledge in that area. Right. So that is the finished recording in week 3 of accounting and measurement. Next week, we're then going to move on to IAS1 recap, looking at the preparation of financial statements. So remember, in advance of that, please look at the 4 AF1 recap quizzes that are available on the Loop page. Thank you very much.